Welcome to this live queue with Formpipe. After the presentation, I will host a Q&A session, and you can already now send us your questions on our homepage. But now it's time for CEO Christian Sundin. You're welcome.
Thanks, Fredrik. Thanks everyone out there joining in for this session. My name is Christian Sundin, as Fredrik said, and I'm the CEO of Formpipe. Today I will only focus on the Q1 report that we published this morning. For other topics or interest in our company, please reach out to me for an offline session. So, the Q1 highlights. How did the report look like? Yeah, we show a 19% growth from last year. Our investment in our new growth strategy that we launched a little bit more than a year ago is paying off, and we see strong demand both in private and in public sector. We have also a 9 million ACV number compared to 7 million for Q1 last year, which we considered back then as a paradigm shift upwards and was a strong number then. And we now continue to prove even stronger number of ACV and thereby ARR growth. We see that also a big chunk of our growth comes from deliveries. In line with our strategy to become a one-stop shop for digitalization of the public sector in Sweden, as we already are in Denmark, we have increased capacity in order to help our customers on the digitalization journey and thereby growing the delivery revenue, but in both Sweden and Denmark on the public sector space. It's been a busy quarter. Not only to the better, the war in Ukraine is affecting us deeply. We have since many years, more than a decade back, a very strong relationship with our partner, subcontractor in Ukraine. We have a team of plus 100 people that we know very well. We know the names of our people's families and dogs, and we are having a huge concern with the situation as it is right now. The people are truly heroes. They are actually working and work for us in a very productive way during these circumstances. We're relieved to know that the team has moved to safer locations within Ukraine and are able to work as it is right now. And according to them, the best way we can support our teams in Ukraine right now, that's to continue to provide work for our teams there. If this situation becomes even worse, we have contingency plans. We can move our product development outside of Ukraine and will do so if necessary. But at this given moment, we want to show our support the best possible way we can to the Ukrainian teams we have there. On the much more positive side of the busy quarter, we early in the quarter acquired our former partner Alchemit, and we have been very busy in integrating that acquisition in our business, and especially within our public sector Sweden business area. If we go back a year in time when we launched the growth strategy, we have executed very well on it when it comes to private sector and when it comes to public sector Denmark. However, the shift of business model that we pursued in terms of public sector Sweden, we didn't really manage to do that as well as we hoped. The acquisition of Alchemit provides us all the experience, competence, capacity, structures, and so forth in order to really execute on that one-stop shop strategy for public sector Sweden. We consider having cut approximately 2 years on execution on that strategy by acquiring Alchemit, and we're very happy to have Alchemit people aboard. We are talking about people, we are at the end of the quarter 293 persons in our business, and that's 31 people up from last year. Our ambition is going forward to continue to grow in a similar pace as we've done the recent year. However, it is a fierce competition for talent out in the job market at the moment, and we will continue to go on this path. We believe that we have a strong offering and that we are a good employer for our people, and will continue to add on capacity during the year. So, coming to the numbers. As I pointed out, we have a growth of 90% year-on-year, which also corresponds to 19 million Swedish. The growth is primarily driven by increase in delivery revenues in line with the strategy I just mentioned. However, we also see a strong growth in recurring revenue, primarily driven by SaaS growth, and that's up 7 million compared to last year. License revenue, however, in line with transformation that is ongoing from traditional license sales to more SaaS subscription based revenue. We see an historically low level, dropping 3 million from last year in license revenue, and we see that part of our revenue, very limited part of our revenue right now, and going forward. And that's also due to that now we don't only see a strong growth and a strong demand for recurring revenue in the private sector, also in the public sector, we're transforming along the path of having more recurring revenue rather than traditional license sales. When it comes to cost, the investment we're doing to pull off these growth numbers is costing money. We are increasing capacity. People cost money from day one, while the revenue comes slightly later than the cost. So the 19 employees up from Q4 and 31 from last year, that drives staff cost, which is up 14% from last year. Sales expenses are also partly driven by subcontractors, more subcontractors in delivery projects, which we aim to replace by internal recruitment, internal resources by recruitment. But also the strong growth in sales also drives partner kickbacks in, especially in the private sector, where we see mainly or more or less only in the private sector where we see the international expansion. We have partners and we have a partner kickback schedule, meaning that the strong growth in private sector also becomes a lot of kickbacks to our partners. Other costs are also higher, coming from a couple of years with pandemic situation, where both travel and conferences and so forth and possibility to meet people has been limited. It's now when the society is now opening up, we see an increased spending in travel and meeting up people. But we also are increasing proactively our marketing efforts to drive sales even faster. So total cost excluding capitalization, which we put through the balance sheet, which mainly is an accounting thing where we put our investment in our products through the balance sheet. If we take those apart, we see that the total costs are up 21% from last year, and that of course puts a damp on the profitability on the EBIT side and the margins. So coming back to the ACV, we show another strong ACV quarter, 9 million or almost 9 million. Primarily driven by growth in SaaS revenue, which sums up to almost 7 million of the 9 million. We see also that even though I said that public sector is now catching up on private sector when it comes to subscription and SaaS, we see that in our case it's still private that accounts for the major part of our ACV. However, as we see, there are solid growth numbers in ACV also in both Danish and Swedish public sector. So, summing this all up, the growth strategy that we initiated a little bit more than a year ago, if we go back, we can see this is a very long track record of our growth of SaaS revenue on very small numbers for a number of years until we increase capacity and really put our effort into to drive the SaaS sales. And we can see the shift from last year on 5 million, now going to 7 million in comparison from last year. And we see how the SaaS ACV has developed over time. So we're looking forward for strong ACV quarters coming the rest of the year as well. So with that said, a solid report. The costs are, as what I can read from analysts, higher than expected. But the growth and the investment in growth and ACV build-up is really paying off in line with expectation. So we're looking forward to the rest of the year. Thank you.
Thank you, Christian. And I want to start with a question regarding Alchemit. You seems quite happy with the acquisition. I mean, what is it that has done well so far?
Well, we to be honest, we struggled with building our own delivery organization during 2021. We really made an effort, but we didn't really succeed all the way we wanted. With the skills, the knowledge, and the experience, and bearing in mind that the Alchemit people that we brought in, many of them have been working with Formpipe products as a partner for a decade. They have a lot of experience that they bring in and knowledge about how to deliver our products. We know how to build our products, and we've known that for long. But to deliver, understanding the customer needs, and have process for that, having a good resource allocation on it, and planning of the delivery, we were not up to it. We thought we were going to be able to find our way on it. We didn't do it very successfully. Bringing Alchemit just brings all of that to the table for us. And now we reorganized the business area in total. It is two of the Alchemit, three actually, a number of them are in leading positions now in our delivery organization for the public sector Sweden. So we're really taking it's sort of the other way around. We acquired Alchemit, but we're adopting all of their way of that they have known and how to do this. So it's a big shift. It's been not without pain during Q1 in productivity and so forth, but we see clear progress during the quarter that we're doing the right things here and are really positive about the future in it.
Okay, interesting. As far as I understand, the demand in basically all your segments, but specifically in public Sweden, is very large, and your resources is the limiting factor. So, I mean, how many Alchemits or personnel equal to that would you need to be able to keep up with the demand approximately?
Well, we have plus 200 customers in the public sector space. And that is a potential market for our current customer base. On top of that, we have winning new customers through bids or tenders in the market. So, yeah, we are only doing with the capacity we're having today a small fraction of all the services that are done on our customer base that we have today. So there's a huge potential for us to grow in that. However, we still have very loyal partners out there that are doing a lot of that work. We're not saying we're going for all of it. We want to have a big enough delivery capacity to be able to take on the largest customer ourselves, where we think that's strategic. But the main reason for us having our own delivery capacity is to get the innovation power, to get the ideas of co-creating new modules to one customer and then sell it to all of the other customers. So the delivery revenue it should facilitate stronger growth of recurring revenue of products. So how far we will go in this strategy is dependent on what the customer thinks, what the other partner are doing, how well they are helping our customers, and so forth. But there's a huge potential in it.
Okay. Also, I want to highlight the opportunity to ask questions on our webpage. You want to expand your organization, and in most areas, as you have talked about previously, there's a tough competition for talent out there. So what can you do to become an even more attractive employer?
Yeah, I think that's a challenge everyone struggles with today. It's fierce competition for talent. We try to stay relevant, of course, and be on market levels for when it comes to salaries and salary packages and so forth. But we're also, we are a relevant company. We believe that we have cutting edge in terms of that we actually provide real value to the society, looking on how we treat our employees, a solid balance between work and free time and so forth. So it's all of those bricks that needs to fit in place, but it still will be competition for talent. That's so we're of course trying to do all of that, and we are doing that. Still, as it is right now, it's fierce competition. Yeah.
Okay. You mentioned that the license revenue was the lowest we have seen for a very long time, at least, and that the public sector is also turning towards software as a service. I mean, why is that happening right now, do you think?
Well, it's not only what we can say. We are offering our customer, the current customer base, when we're upselling to those, we offer that as a software as a service now, rather than saying it's a one-off tradition. So it's driven by us when we talk about upselling to the current customer base, where we already have an agreement in place. It's possible for the customer to buy that way, but it's also that they've gotten used to it. So it's a matter of maturing for the fact that the world is moving in that direction when it comes to software. So that's the main reason we see that in our numbers. When it comes to tenders, I would still say it's like a 50-50 split between traditional license and buying it as a service we see on the tender arena.
Okay. There's a rather high inflation right now, and if I interpret you correctly, there's also that regarding salaries, not at least in the US, when you want to expand. I mean, how's your possibility to increase prices to compensate for that, would you say?
If we talk US specifically, our main offering or our only offering on the US market is Lasernet and Autoform together with Microsoft Dynamics and Temenos, and we are a part of those partners offering. Looking on the Azure prices from Microsoft, that we buy a lot of Azure ourselves. Those are there is a price increase in that, and if the same applies for Dynamics, for example, we are a portion of that, so we will piggyback along on those price increases. However, I don't think we are in the driving seat of driving those price increases. We are going with the full package with our partner on that. So, but it's likely that we will be able to raise prices over time. Not as quick as we see the salary increases hitting us right now, though.
Okay. Once again, I want to highlight the opportunity to ask questions on our homepage. As you mentioned, me and some other analysts might have underestimated your pace of expansion slightly. Maybe due to last year was quite strong in terms of earnings compared to what you have guided for. But I mean, could you give us some guidance or at least discuss the question? I mean, for how long would you like to keep up a high investment pace, or is that impossible to say at this point?
Well, we see that we have strong demand in all our business areas, and we want to go for that demand in the market. We see that increased capacity is needed to go for that growth capacity, that growth potential. So as long as we see the investment paying off for us in terms of growth, we will continue to reinvest parts of it. However, bear in mind the business model we're having with a large portion of recurring revenue. If we add, let's say, 30 people per year, we will still carry along the revenue that will help us from previous years of growth. So those 30 FTEs added per year will be a smaller and smaller part of the total financing or the total P&L of our business if we play with those thoughts. So the margins will come back. It's approximately a year delay. If you stop them increasing, then you have a year delay, and then you will raise above with the ARR coming approximately a year after the actual cost. But we're not intending to stop the investment, but it will be a smaller portion if we keep it flat. But I mean, we're not running the business one decision over 5 years. We're taking new decisions every day. And as I said, as long as as clearly as this sees that the investment is paying off, we will continue to reinvest in further growth. But of course, if we would flatten out now, the margin would quickly come and go above what we ever had with the strong 315 in ARR that we're ending the quarter with. So the underlying strength is there. It's just not visible yet.
Okay. The ACV, I mean, it's still on a high level compared to historical levels. I think the graph that you showed before really highlights that. However, it's slightly below what we've seen in mid of last year. I mean, is that a seasonal effect, or is it rather a natural fluctuation where you had some large Temenos orders, for example, or what should you...
Yeah, it's both, I would say. I mean, even though ACV is borderline as binary as the traditional license sales we had back in the days, since it's a yearly number. So it will fluctuate. I think we've proven strong numbers for a lot of continuous quarters now. Seasonality is probably one where the Q4 is normally a strong quarter, at least in the public sector space. And perhaps we emptied some pipelines there. When it comes to Temenos, as you say, it's much fewer Temenos deals per year than we have Dynamics deals. And this was a quarter without any significant Temenos deal. And that will fluctuate over time for us. So it's a combination of the two things that you're mentioning.
Okay, that's all from us. Thank you very much, Christian.
Thanks, Fredrik. Thank you.